Greetings, and welcome to the Simulations Plus fourth quarter fiscal 2021 financial results conference call. At this time, all participants are in a listen-only mode. A brief question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce Brian Siegel from Hayden IR. Thank you, Mr. Siegel. You may begin your presentation.
Good afternoon, everyone. Welcome to our fourth quarter fiscal 2021 financial results conference call. Hosting the call today are Simulations Plus's CEO, Sean O'Connor, and CFO, Will Frederick. An opportunity to ask questions will follow today's presentation. Before beginning, I would like to remind everyone that except for historical information, the matters discussed in this presentation are forward-looking statements that involve a number of risks and uncertainties. Words like believe, expect, anticipate mean that these are our best estimates at the time, but that there can be no assurances that expected or anticipated results or events will actually take place, so our actual future results could differ significantly from those statements. Factors that could cause or contribute to such differences include, but are not limited to, our ability to maintain our competitive advantages, acceptance of new software and improved versions of our existing software by our customers, the general economics of the pharmaceutical industry, our ability to finance growth, our ability to continue to attract and retain highly qualified technical staff, our ability to identify and close acquisition on terms favorable to the company, and a sustainable market. Further information on our risk factors is contained in our quarterly and annual reports and filed with the U.S. Securities and Exchange Commission. With that said, I'd like to turn over the call to Sean O'Connor. Sean?
Thank you, Brian. We had an encouraging end to the fiscal year as we saw continued momentum in our software business, and the decline in our services business was less than we saw in the prior quarter. For fiscal 2021, our total revenue growth came in at 12%, exceeding our guidance of 5 to 10%. Software revenue growth for fiscal 21 was 28%, exceeding our guidance of 20 to 25%, and the service revenue decline was 6%, slightly better than our guidance of 7 to 12%. Our software business had a good quarter, reflecting the strength of both GastroPlus and ADMET Predictor, each growing by at least 20%, partially offset by the expected decline in MonolixSuite due to early renewals that occurred in prior quarters. Software revenue growth in fiscal 2021 increased to 28% compared to last fiscal year's growth rate of 17% and 11% in fiscal 2019. GastroPlus revenues grew 20% in the fourth quarter, and we attribute this strong performance to our industry-leading technology and focused upselling efforts, which produced 14 new commercial contracts during the quarter. During the fourth quarter, GastroPlus also saw 17 peer-reviewed journal articles reflecting the strength and recognition of our industry-leading PBPK platform. ADMET Predictor revenue growth in the fourth quarter was 26%, as it continued to benefit from the Q3 product release that added valuable new features and functionality. Additionally, I want to emphasize that both GastroPlus and ADMET Predictor continue to expand their strong leadership position in the market during the year. For example, we saw 20 multi-year GastroPlus licenses signed, 3 new $100,000 plus customers, and 14 upsells during the year. And our new DDI module has been very well received, all of which are a strong validation of our leadership position. As anticipated, MonolixSuite revenue declined in the fourth quarter due to early renewals in prior quarters. For the full year, revenue growth was 20%, as we continue to see both new commercial client adoption as well as displacing alternative products and taking market share from our primary competitor. Turning to our services business, as a reminder, our service revenue is non-recurring. Accordingly, this business can exhibit volatility both quarterly and annually. PKPD projects are typically in the 1 to 200,000 range, and QSP/QST projects can be significantly larger. Sometimes these projects are accelerated, delayed, or even canceled by our customers based on their internal priorities or timelines and are not under our control. While it was a challenging second half of the fiscal year due to the uncharacteristic events of the third quarter, with higher than normal customer project delays and cancellations, we saw signs of optimism during the fourth quarter as revenue decreased less than expected. Our backlog grew sequentially, and our pipeline continued to build. During Q4, we saw the number of customer project delays and cancellations return to more normal levels. We also had a good bookings quarter highlighted by closing 5 new clients, which contributed to a 10% increase in backlog for the quarter and a 49% increase for the full year, which was about 110% of our internal target. During the quarter, we also provided critical support for a multi-regional regulatory approval and supported an FDA submission for a new COVID-19 therapy. For the year, we took action and made several operational improvements that drove margin enhancements, leading to increased average contract value, project yield, and consultant utilization rates. For the QSP/QST business, revenue was down in Q4 as expected. Despite this decline, we saw positive signs that point to an inflection point in this business. We had 1 new and 1 renewal of DILIsym consortium members during the quarter, and overall pipeline activity accelerated, reflecting strong momentum as we enter fiscal 2022. We are also seeing toxicology project opportunities picking up and have multiple QSP projects in late-stage proposal status. I'm also encouraged that we have already achieved our bookings target for Q1 of the new fiscal year. And finally, our PK business saw a 63% increase in backlog for the year and finished strong with 2 significant FDA-funded projects announced during Q4. Looking to fiscal 2022, modeling and simulation adoption continues to be strong in the pharma and biotech marketplace. Internal modeling and simulation resources continue to grow, and they are seeking out our software platforms to achieve their objectives. Outsourcing also remains a robust part of our clients' efforts to meet their needs, and we're here to support them with our service business. Our software business carries strong momentum into the new year as we continue increasing our revenue growth rate as a result of enhancements to our technology, ongoing product portfolio expansion both internally and through acquisitions, and investment in our sales and marketing efforts. In fiscal 2021, our service business experienced the downside of what can be a volatile business, but we saw no fundamental changes in the market that would prevent this business from returning as a positive contributor to revenue growth in the future. Despite this decline in fiscal 2021, we enter the new year with increased pipeline activity, a rebuilt backlog that should drive sequential revenue growth on a quarterly basis in fiscal 2022. With these positive tailwinds, the financial outlook we are providing today anticipates a recovery of our services business and growth accelerating sequentially as the fiscal year progresses. We expect to return to double-digit growth in total revenue in the range of $51 to $53 million, reflecting 10 to 15% year-over-year growth. We expect software to be in the range of 55 to 60% of total revenue, and services to be in the range of 40 to 45% of total revenue. And finally, we will continue our successful M&A strategy to expand our software portfolio and service offerings and grow our overall market opportunity to broaden our capabilities and further support our clients. Of course, any acquisition would be incremental to this outlook, and with future acquisitions, we believe we can continue to grow at a pace that supports our CAGR target above 20% that we've achieved since the Cognigen acquisition in fiscal 2015. Let me now turn the call over to our CFO, Will Frederick, to discuss the financial results.
Thank you, Sean. Our total revenue growth rate for the quarter was 3% due to the challenges in our services business and the early Monolix Suite renewals that occurred in prior quarters. Software revenue growth for the quarter was 14%, and services revenue declined 7% for the quarter. We continue to see improvement in our software and services revenue mix, with software now at 55% of total revenue for the quarter. Our total revenue growth rate for fiscal year was 12%. Software revenue growth for the fiscal year was 28%, and services revenue declined 6% for the fiscal year. For the fiscal year, software is now at 60% of total revenue. For the quarter, software gross margin increased from 83% last fiscal year to 85% this fiscal year due to the increased revenue in that business. The services gross margin for the quarter decreased from 61% to 55% due to the revenue decline in that business. The revenue mix trends positively affected our total gross margin for the quarter, which remained at 72%, comparable to last fiscal year. For the fiscal year, software gross margin increased from 87% last year to 88% this year, and the services gross margin for the fiscal year remained unchanged at 61%. The revenue mix shift had a greater impact on total gross margin for the fiscal year, and our total gross margin increased from 74% to 77%. For the quarter, GastroPlus represented 57% of our software revenue, AdMet Predictor was 22%, Monolix Suite was 15%, and other software was 6%. For the year, GastroPlus represented 59% of our software revenue, AdMet Predictor was 18%, Monolix Suite was 16%, and other software was 7%. We continue to enjoy solid revenue growth and diversification across our entire portfolio, as evidenced with the software mix change since last year when GastroPlus was 66% of our software revenue, and Monolix Suite was only 7%. We continue to see improvement in our average revenue per customer, again this quarter, with an increase from $62,000 to $65,000 for commercial companies and from $42,000 to $55,000, including nonprofit and academic customers. Our renewal rate for the quarter based on fees was 90%, up from 88% last fiscal year, and would have been higher except that 5 customer renewals slipped into the next quarter. Our renewal rate this quarter based on customers was 77%, down from 93% as expected, with our recently announced University Plus program that offers free access to our software for students and educators as part of our ongoing support of academic research training and collaborations. We believe this program will increase modeling and simulation education and help prepare the next generation of scientists and contribute to the rapid development of safer, lower-cost treatments for patients worldwide. With this program, we saw a decline in paid nonprofit and academic renewals, and will exclude them from our reporting beginning next fiscal year. For the fiscal year, we also saw improvement in our average revenue per customer, with an increase from $111,000 to $121,000 for commercial companies, and from $69,000 to $85,000, including nonprofit and academic customers. Our fiscal year average revenues per customer are higher than those for the quarter due to larger deals that occurred during the fiscal year. Our renewal rate for the fiscal year based on fees was 92%, down slightly from 93% last fiscal year due to the customer renewal slippage for the 5 customers I just mentioned. Our renewal rate this fiscal year based on customers was 83%, down from 89%, primarily due to nonprofit non-renewals as they transitioned to the University Plus program. Let me shift now to our services business. For the quarter, our services revenue breakdown was 53% from PK/PD services, 25% from QSP/QST services, 16% from PB/PK services, and 6% from other services. For the full year, the breakdown was 49% from PK/PD services, 28% from QSP/QST services, 14% from PB/PK services, and 9% from other services. With regard to a couple of key service metrics, total services projects completed during the year increased 36% compared to the prior fiscal year, which increased 24% compared to fiscal 2019. We've started breaking out other projects this fiscal year that were previously reported in PK/PD, QSP/QST, or PB/PK to provide additional visibility to this increasing activity and reflect the continued expansion of our services offerings. We ended the fiscal year with $13 million in backlog, up $2.5 million from the prior fiscal year end, reflecting a 24% increase and nice recovery from the decline we saw at the end of fiscal 2020 compared to fiscal 2019. Now turning to our consolidated income statement. SG&A expense for the quarter was $5.6 million, or 57% of revenue, compared to $3.7 million, or 39% of revenue in the same period last fiscal year. Approximately $700,000 of this increase was a catch-up this quarter as a result of switching from a semi-monthly payroll to a biweekly payroll during the fiscal year. As part of our integration efforts and one company focus, we consolidated our payroll for all U.S. employees and moved to a biweekly payroll. The true-up with 7 payroll periods in Q4 is reflected in the quarter and has no impact on our fiscal year expense. We've also seen costs increase since last fiscal year in insurance, external professional fees, recruiting, and stock comp expense. Lastly, we had salary increases during the fiscal year to remain competitive with increasing market salaries, and we increased our headcount by 9 employees during the fiscal year from 137 to 146. Total R&D costs for the quarter were $2 million, or 20% of revenue, compared to $1.6 million, or 17% of revenue, in the same period last fiscal year. R&D expenses for the quarter were $1.3 million, or 13% of revenue, compared to $0.9 million, or 9% of revenue, in the same period last fiscal year. Capitalized R&D for the quarter was $0.7 million, or 7% of revenue, compared to $0.6 million, or 6% of revenue, in the same period last fiscal year. Income from operations was $0.2 million, compared to $2.2 million in the same period last fiscal year. This decrease was primarily driven by the higher SG&A costs I just described, plus increased spending on R&D to support our product development efforts. The income tax benefit was $0.1 million for an effective tax rate of negative 73%, compared to an income tax benefit of $0.2 million, an effective tax rate of negative 7% in the same period last year. We continue to see a lower effective tax rate primarily driven by the tax benefit associated with disqualifying dispositions that we've seen throughout the fiscal year. Net income was $0.3 million compared to $2.2 million for the same period last fiscal year, and diluted earnings per share was 1 cent compared to 11 cents for the same period last fiscal year. Ebitda was $1.1 million compared to $2.9 million for the same period last fiscal year. For the fiscal year, SG&A expenses were $20.6 million, or 44% of revenue, compared to $16.4 million, or 39% of revenue last year. The increase in SG&A expenses was primarily the result of higher payroll-related expenses due to increased compensation to remain competitive with increasing market salaries and the increased headcount I just mentioned. We've also seen cost increases since last fiscal year in contract labor, insurance, professional fees, and stock compensation expense driven by our stock price during the fiscal year. Total R&D costs were $6.9 million, or 15% of revenue, compared to $5.3 million, or 13% of revenue in the same period last fiscal year. R&D expenses were $4 million, or 9% of revenue, compared to $3 million, or 7% of revenue in the same period last fiscal year. Capitalized R&D for the year was $2.9 million, or 6% of revenue, compared to $2.3 million, also 6% of revenue in the same period last fiscal year. Income from operations was $11.3 million compared to $11.6 million last fiscal year. Income tax expense was $1.3 million for an effective tax rate of 12%, compared to an income tax expense of $2.1 million, an effective tax rate of 18% for last year. As previously mentioned, we saw a lower effective tax rate throughout this fiscal year, primarily driven by the tax benefit associated with disqualifying dispositions. Net income increased 5% to $9.8 million, compared to $9.3 million for last fiscal year, and diluted earnings per share were 47 cents, compared to 50 cents last fiscal year. Adding back the 2.1 million shares of common stock issued in our follow-on offering last August would result in diluted earnings per share increasing to 52 cents this fiscal year compared to last year. Ebitda also increased to $14.5 million compared to $14.3 million for the same period last fiscal year. We continue to have a strong balance sheet. At the end of the fiscal year, our cash and short-term investments balance was $123.6 million, compared to $116 million at the end of last fiscal year. Our strong balance sheet reduces the need to secure additional capital as we're continually evaluating strategic acquisition opportunities that we believe can further position us for success and support our long-term revenue targets. We also continue to have no debt on the balance sheet. I'll now turn the call back to you, Sean.
Thank you, Will. In conclusion, strategically, we continue to reinforce our leadership in our portion of the biosimulation market for pharmaceuticals, as the industry's adoption of model-informed drug development tools and techniques continues to expand at a rate 4 to 5 times that of overall R&D. We remain well integrated with both academia and regulatory agencies, giving us scientific capability as we look to the future. As a result, our software business is doing very well, with accelerated growth rates and expanded capabilities, and our service business is steadily normalized, as evidenced by our improving backlog and strong bookings. This performance gives us confidence that we have clear line of sight to delivering consistent, longer-term growth in line with our growth expectations. With that, I'll be happy to take your questions. Operator?
At this time, we will be conducting a question-and-answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 to remove your question from the queue. For participants using speaker equipment, it may be necessary for you to pick up your handset before pressing the star keys. One moment while we poll for questions. Thank you, sir. Our first question comes from the line of Matt Hewitt with Craig-Hallum Capital Group. You may proceed with your question.
Good afternoon. Thank you for taking the questions, and it's nice to see the bounce back in the services side of the business. Maybe to dig in a little bit there, last quarter, as you called out on the last call, was abnormal in the number of cancellations, deferrals, and whatnot. it seems to have bounced back very quickly. What are you hearing from your customers? Have any of those contracts that were maybe deferred, have those closed? Any incremental color on the services side would be helpful.
Sure, Matt. It headed back to normalization, and normalization doesn't mean that there are no cancellations or delays or holds as peaked in the third quarter, but down to a level, which, as I've said before, is typical. 2-3 of these occurrences during a quarter is something that we can manage around more adeptly, and so good outcome in that regard. Is there any market indicator as to why the frequency, stepped back down? Hard to pinpoint. In the toxicology area, in the QSP area, we are seeing some indication based upon requests for proposals and a healthy increase in our pipeline that FDA responses back to companies has picked up. And that's a good sign, so certainly can point to that. I would say that it is still a market in terms of our PK/PD services where projects come under greater scrutiny, I think, than in the past, and holds, delays, and ultimately cancellations, as I think I've said before, are a good sign that the fail fast move to the next drug opportunity when this one indicates a less than likely success profile. I think that's a phenomena that is a good one, and we're going to have to manage the service business around on a go forward basis. But other than that, no flare guns from the marketplace.
That's great. Shifting to the software side, a good quarter, better than our estimates anyway. Yet it sounds like you had 5 renewals that slipped. Have any of those closed already here in Q4? And is there anything to kind of pick at with those 5, or is it just a timing situation?
All 5 closed in the week after the end of the year.
That's great. Okay, and then maybe one last one from me, and then I'll hop back into queue. You mentioned that you are seeing continued market share gains, and I'm just curious if you've seen anything from a competitive response, or is this something that we should expect as we get into 22 and into 23? Are you going to continue to take share? Thank you.
Yeah, our comments there are specifically with regard to Monolix, and their growth is certainly well ahead of the growth for NMLE applications out there as a whole, overall market growth. So, clearly we're taking some market share of existing players there. Have we seen a response in that regard? Nothing of great significance. The market for Monolix is responding very favorably to its ease of use, the workflow approach, and quite frankly, our clients are attracted to the same benefit that we see internally, where we are completing PK/PD projects more efficiently and utilizing less time to get to end of job when we use Monolix. So very good progress on the Monolix side, and it continues its momentum into next year.
Got it. All right. Thank you.
Our next question comes from the line of Francois Brisebois with Oppenheimer. You may proceed with your question.
Hey, thanks for the questions. Just quickly here, I was wondering what makes you so confident? It seems that 51 to 53 is pretty tight. What gives you confidence to give guidance, due to the fact that it seems like this pandemic is lingering quite a bit? So any factors there?
Well, two sides of our business. On the software side, with its high recurring revenue renewal rates, gives us the benefit of being pretty confident in terms of the direction of that business. And it's really picked up in the back half of this year. Really over the last 3 years, we've seen the growth rate, organic growth rate of our software business step up and continue to deliver higher growth rates. And so our software business is performing very well. The COVID impact there, even when we look back at the brunt of the COVID impact a couple of years ago, our software business wasn't unaffected, but was minimally affected. So high degree of confidence on the software side. Still cautious on the service side. That is where COVID can have its biggest impact, with the disruption in terms of clinical trial timing, drug programs being altered and changed and reallocated to other programs in response to things like COVID. And there we keep a little bit higher discount factor in our heads as we prepare guidance. But a combination of those two gives us high confidence in an environment that software is performing well. And on the service side, our underlying pipeline and building a backlog, new contracts being closed, is moving quite nicely as we exited the year and began the year here in fiscal year 22.
Okay, great. And this has been touched on in the past, but I was just wondering, on the M&A front, have you seen valuations come down a little bit? And just remind us, has it changed the criteria that you're looking for? Is it more geographical? Any color there on what you're looking for when you study up M&A?
Yeah, I mean, our criteria remain unchanged, and the targets that we seek, are both software and service. Although software is a focus for us, there are some geographical benefits in some locations that would be an attraction to a target if it was in the right locale to support our expansion on a global basis of our service coverage. But on the valuation side, the financial criteria of our M&A strategy remains, unchanged. We're looking for accretive opportunities, and that interplays obviously with valuation quite quickly. Company's got to be performing well, and the valuation has to be appropriate so that it is accretive to us. Have valuations come down? Boy, the discussions are a little bit easier than they were, say, a year ago. Doesn't mean that they're not tough. And I think we still see in the healthcare space and certainly biosimulation space that in addition to market valuation metrics that might be referred to in valuation discussions, we also see a lot of private companies, private equity funding that comes into play, and that affects valuations as well. So the headline is, valuation discussions are better than they were before. That doesn't mean that they are necessarily easy parts of the discussions that are ongoing in terms of target candidates that we interact with.
Sounds good. And then just quickly, a quick two questions on the financial side. There was a little jump here on the SG&A side. I think it's 57% of revenues in the fourth quarter. I think you discussed maybe the contract costs went up, or maybe the payroll went up as well, and more employees added to the team. Can you just help us understand maybe SG&A going forward, what to expect here?
Yeah, fair enough. A couple factors in play there. We'll go through the details of the payroll. We did a merger of our three legal entities, essentially SLP, Cognigen, and DILIsym from the acquisitions, to roll up into one legal entity for multiple purposes that support both our consolidation integration process internal for the company, as well as external cost savings on a number of fronts that will now accrue to us. That ultimately had some changes in our payroll systems coming together that didn't change our payroll cost overall for the year, but lumped it into quarters a little bit, non-consistent or non-linearly. Other expenses that came into play in the fourth quarter, all of which, if you look and focus in on Ebitda, our Ebitda percentage of revenue only declined a couple of points in an environment in which we saw revenues in the back half of the year well below where we would be expected to be. And in terms of our most precious asset, our employees, our scientists, not only is it a compensation competitive marketplace that we need to respond to, and that provides some pressure and uplift to the costs in that area, but as well, while revenue in the service business was down, it wasn't a situation in which we were going to shave off our organization to reduce expenses to match that revenue. These are valued assets in this industry, and so there's some play there as well in terms of OPEX being a little high in the fourth quarter. Our expectations are on a go-forward basis that nothing has fundamentally changed in terms of our OPEX, our profitability profile, and we expect that fourth quarter percentage of revenue on OPEX to be a bit of an anomaly, and we'll return to where we've been the last year or two in OPEX on a go-forward basis.
Great. That's it for me. Thank you very much, and congrats on the quarter.
Take care, Frank.
Our next question comes from the line of Dane Leone with Raymond James. You may proceed with your question.
Hi. Thanks for taking the questions, and congratulations on the quarter. So just similar questions here, but do you have an idea of how active you think you're going to be in terms of acquisitions in the coming year? I think we get that question a lot of how you can get a bit more aggressive. So is your messaging today that valuations you feel are still prohibitive from engaging in M&A, or you expect some deals to get done over the next 12 months? And I have a follow-up.
Sure, Dane. Obviously we can't pinpoint and target a predictive date in terms of acquisition, but I think now versus a year ago, the number of discussions that are active, the nature of those discussions being a little less cloudy because of valuation certainly gives me a pretty optimistic view that an acquisition can be achieved in the coming time frame. Now, does that mean in 3 months, 4 months, 8 months, 9 months in the next year? We certainly are motivated to find the right target, close a deal that meets our criteria, and add it to the portfolio of Simulation Plus companies as quick as we can. That said, it's a market and a process that can't be predicted with exact clockwork. So confident that we will continue to invest the resources necessary to identify and pursue appropriate targets out there. Confident that they exist, and that at some point in time we'll have an announcement in this regard to bring to you.
Okay. Any specific size of deal that you think is going to make more or less sense, maybe in terms of the target revenue generation?
Well, there's a range of the targets that we're in discussions with right now. Lixoft, I'll just use as a leverage point in response here. We're close to $4 million in revenue. Those sort of targets, or that level size of target, is pretty plentiful in our discussions today. That being said, that there are some targets that would be of a higher size than that, higher revenue levels than that. On the service side, most of those organizations are at the Lixoft or below size in terms of their revenue flow. So on the service side, they tend to be a little bit smaller groups of consultants that would be targets. I'd use Lixoft as a good example in terms of size, and maybe there's some opportunities that are a little bit larger than Lixoft out there.
Okay, great. And last one for me. Can you just clarify in terms of the response of the operating margin this quarter and the I guess abnormal SG&A spend? Is that, are you clarifying that that's a one-time increase or one abnormality, I guess, for whatever you were doing with consolidating those businesses, or is there a new higher run rate that we have to expect for SG&A?
Yeah, I think for the most part it's a blip in the quarter. Obviously our growth of 9 people, continuing compensation response to the marketplace. There are some expenses that are going up, but certainly that which is attributable to the payroll adjustment, I think we'll reference the number of about $700,000 in the quarter. That expense or that amount is not recurring in nature.
Okay, thank you.
I'd add on there. I'm happy to add on there. It's for Q4 timing is what I would focus on it, and for the year, it's where we came out in the revenue growth with services challenges. If you go back and look at, say, first half of the year, and we were at about a 21% growth rate. From an absolute dollar standpoint, our operating expenses will continue to go up, just driven by higher revenue, as well as bringing more people on at a controlled pace, but keeping competitive in salaries. But if we ended up where we had looked at the beginning of the year, I think our total R&D would have still been in the 7 to 8% range, which is about where we were last fiscal year, and our SG&A in that 41 to 42% range. When you look at things as a percentage of revenues, still trying to keep operating expenses, in total below that 50% sort of number. But timing was the Q4 with expenses coming in this quarter versus other quarters.
Okay, thank you very much.
Yep.
As a reminder, if you would like to ask a question, please press star 1 on your telephone keypad. One moment while we poll for questions. There are no further questions at this time. I would like to turn the floor back over to Mr. Sean O'Connor for closing comments.
Very good. Well, thank you, everyone. We are pleased that we saw some uptick in terms of where we came in the fourth quarter compared to a challenging third quarter, and are very pleased with the momentum on both sides of our business, both the software and service businesses as they enter our new fiscal year. Look forward to reporting further results a quarter from now to you. Take care. Thanks a lot.
This concludes today's teleconference. You may disconnect your lines at this time. Thank you for your participation. Enjoy the rest of your day.